Hello, everybody. October 20th. This is the Macro Dashes and Global Trends ETF webinar, done every Thursday at noon. You can find the details in your subscription, or if you just visit Fundamental Trends or my blog at Seeking Alpha, the details are there too, if you'd like to join us live. Starting next week, we'll be able to take 500 participants instead of 100. So you are more than welcome to come and listen in. For those of you who aren't aware, I finally got around to working on my investment firm website. If you had a registration with it, you got a password reset message yesterday. A couple of you have contacted me. Pretty easy way to reset your password. You just go here. It says log out to me because I'm logged in. But if I were logged out, it would say log in. I just go here, hit forgot password, and I could put in my email address or my username, and I would be able to reset my password. So I am taking clients for investment management again. You can go here, see what the types of accounts are. I have different management for non-accredited investors and accredited investors. Minimum account sizes are different. If you're an accredited investor and want to do the retirement income options strategy, you need $500,000 to do that. I had it set at 300,000. I'm bumping it up to 500,000 because if you're going to be an option seller, you should do it the right way. And it's difficult to sell options on expensive stocks if you don't have enough money. For non-accredited investors, those who just are looking for ETF asset allocation or building a stock portfolio or stocks for growth and income, you can start with $100,000 or $30,000 if you're working and putting in $500 per month. Portfolio consulting we talked about last week. So if anybody wants to do kind of a jumpstart program for investment letter subscribers, let me know. It's $800 to get started, and then you just buy increments of time. All right, shameless advertisement out of the way. I'm going to show you something from Tom Lee again. They have the daily earnings update that they do, and it's decent. It's a good rundown. I get it through Centio and a couple other places as well. What we are finding out is that the earnings are beating estimates, typical rate that they typically do, because we know that CEOs and CFOs dial down the expectations a quarter or two ahead of time. So they can say that everybody's beating estimates by 2%, but given inflation has been what it's been, the reality is that the net profitability of a lot of companies has contracted a bit at the marginal level. So this hasn't quite been the kitchen sink quarter that I and many others expected. We're not really sure why that's happening, but it just doesn't seem like we're getting great results, but they're not horrible either. I do go back to that FedEx earnings report a little while ago where they just said, look, people, you better watch out after the holidays. And I'm just keeping that in mind. I really did think this market would bottom out by the end of this year. A lot of people are saying, look, we might have to deal with things in the first half to even the third quarter of next year. So I hope this bear market doesn't get extended for another 3 quarters or 4 quarters. But there seems to be things lining up that could make that happen. Again, the Fed is the one that we really have to keep an eye on. Mark Newton over here talks about that. He says, look, we might get a rally up to 3,800, and I'll show you why. But it is important that yields peak, and if they don't, we get another leg down. So there's a lot of unknowns right now. There's a lot of things that we're watching that are still unknown. So there's a lot going on overseas. There's a lot going on with the Fed. A lot of moving parts. So picking stocks that you like for the long term, I think, is very important. And if you are trying to be a trader, I'll tell you what, I think things have gotten harder and harder all year. And I would be very careful about trades that you're making for the sake of making trades. If you don't have a really firm conviction on what you're doing, if you're just saying, well, this looks like the best thing I can find today, you got to just sit on your wallet and go do something else. Because I think these trades are getting harder and harder. Look for specific setups that you want to come to you, that you understand, that you think you can make money on. Don't just look for the trade of the day, because I think you're going to get creamed. This is going to get even harder to do until we have more clarity on international markets, geopolitics, and central bank policy. And there's a lot going on in the world of dollars. So let's take a look at TLT that we talked about, smack dab in the middle of my buy zone all of a sudden. So we'll see if this bottoms out in the 80s somewhere, which is kind of what I think, or if it goes to another leg lower, which it could. There's always another leg lower. I mean, we could see interest rates go up another half point or point more than people expect at the long end, and that could drive TLT all the way down into the 60s. So let's be real careful about these trades. I know a lot of people are excited about trading TLT. Well, it's down, it's down, it's down. Well, it's still going down. And you don't have a good setup here on the Elliott wave oscillator. The moving averages aren't doing anything good. MFI still not looking good. Shaking money flow, RSI. Until money starts to come back into the market, we're going to have some problems. And we know that the Fed is trying to take money out of the market. So there's just a lot going on. I mean, these Armageddon zombie apocalypse levels, they're not looking less likely. Here's a dollar. Could it spike even higher? Could it break out past 20-year highs? Could. I use a little bit different measure than others. I like this basket better. But look at this. I mean, it's screaming. If we add other indicators, you have a bullish breakout here, right? 50-day over the 200-day. Elliott wave oscillator is up. Exponential moving averages are up. I don't know where MACD went. MACD, where are you? Okay, where did MACD go? There you are. MACD is still up. This dollar gets stronger. Long bonds go down as interest rates go up. We have some interesting things going on. Right now, we have energy still going up, even with the strong dollar. And everybody always says, well, but if the dollar gets stronger, gold and energy have to go down. Well, gold's getting beat up. Not a lot of utility there. We still have energy problems. And what happened this week? What happened yesterday and today? What have been some of the headlines about what's going on with the Strategic Petroleum Reserve? Exactly what I talked about earlier this week, and really I've been talking about this for months. The Strategic Petroleum Reserve has to get refilled. When it does, right, that means that the oil and gas companies are just going to keep making money hand over fist for probably a few years until we hit that 2026, 2027 inflection point on electric vehicles and solar that I keep talking about. Energy markets are going to be tight till then. Now, the equity market will reflect the future reality a year or two ahead of time. So when do we get the highs in oil and gas stock prices? Probably about 2 years, 3 years out, 24, 25, right in there. And then you'll have energy prices come down because everybody will anticipate all the new supply and the emergence of EVs. And there's going to be a headline someday that countries that we didn't expect to pump as much are pumping more. The panic pumping. There will be panic pumping eventually. But for the next couple of years, and you know that I don't like investing in fossil fuels, I don't think this is going to hit double top and come down. I think you are about to see a heck of a rally. Elliott wave oscillator is positive, but not super pushed. Relative strength index is not overbought, right? Money flow index is not overbought. MACD is just starting to cross over down here, right? Just crossing over. I think this is going to break out. You're going to see XLE over 100. Now, there's going to be components within XLE that do even better. And we picked some stocks. I think Occidental is the easy one. I think Occidental is going to go to 80, 90, 100 before it's completely bought out. But in the meantime, Buffett's going to end up owning half of that company at an average of $40 or $50 a share. Depends on how many more shares he buys to get up to his 50% holding before he launches a tender offer. So Occidental is the easy one. You could have sold puts on all the things that we mentioned in this article. You know, we offered 6 puts that you could sell. Oh, there's the symbols, so might as well show them. Right? Occidental Petroleum, Permian Resources, New Fortress Energy, XLE, PBW is in here somewhere down here. Ametis, PBW. PBW is deciding if it's going to bounce off of this level. Is this a double bottom here or does it fall? Well, I think what the market does is going to be important here. tried to have a crossover, a bullish crossover. It did not get it. Came down, negative Elliott wave, and below its 200-day moving average. So I think you're probably going to get PBW down in the 30s somewhere. I have orders set up at 35. I might lower those. I have a hard time seeing this get down into the 20s, but it could. I think it's going to make a run at 30. So we're probably going to see these crossovers here. Could be kind of the bounce point. I don't know if you can see those little X's there. Take a look at the put call ratio and what happens when there's too many puts. People have to cover, right? Stock market rallied. Now they're rebuilding their short positions, and the market today is having a hard time deciding what it wants to do. I think you're going to see the put call ratio go back up here even higher. Stock prices will be going down and down and down and down as put call ratio goes up. Eventually it'll spike. Then it has to come off. Then you'll get your next bear market rally. And maybe it'll be the last bear market rally. Maybe it'll just be the start of a new bull market. I still think we're lining up for a very strong 2023. If we get a good sell-off here before the end of the year, and we can go into 2023 with a SPY around 3,000, you could see a massive run-up on SPY in January into the first or second week of February. That's kind of the typical pattern. So if we get a chance to buy the S&P 500 this year around 3,000 and stocks within the S&P 500, again, we would never actually buy that index. You could see a pretty huge front-end rally next year. Nobody seems to be betting on volatility all that heavily. It's kind of a normal range. I'd love to see calls on volatility just really, really spike. But we'll see. I'm not seeing anything terribly abnormal. This has been a pretty orderly bear market. Weird. It's a weird bear market. There's a lot of uncertainty out there, folks, and people are acting like there's not. That's kind of frightening to me, because when everybody knows everything, the less they really know. So I'm just sticking with my best ideas. I really like those energy investments. I hate myself for getting more into oil and gas, but got to do what you got to do, right? Got to pad the pocketbook. If we get a moment here where the Freeport McMorans of the world bottom out and the Caesars of the world bottom out, Caesars is close. Those are pretty spectacular buying opportunities. That's not a good sign. They're going to have another leg down. Man, if we can get Caesars under 20, my friends, that is what you call a gift. Caesars is making money hand over fist at this point, managing their properties well. The online business is taking off. And I just showed a headline. They might get a casino in Times Square. That would be spectacular. I just don't see anything bad with certain companies. But some of these zombies, there are quite a few zombies in here in the S&P 500. When they finally take it on the chin, and I don't know if there's been some pull forward on some of their sales. I'm not really sure what it is, but something's not right with the earnings. And I'm going to have to really dig into those over the next couple of weeks as they come out. There's just something not right. With the inflation being what it is, and wages rising, and energy costs high, right? All these things. Are they still getting concessions on their real estate? Is productivity just understated? That's an interesting argument, right? Everybody talks about productivity not rising. But if the earnings are staying up in the face of inflation and flattening sales, it's got to be something, right? It's got to be productivity. And it's got to be productivity that are just not measuring well. And in an age of technology, that would make sense, right? Regulators, lawmakers, data scientists, they're always behind the curve because time changes things. Technology changes things. So I guess that'd be the one thing that I'm wondering about the most is the economy really more productive in this age of quiet quitting than we think it is? Is it the AI, is the machine learning? What's causing it to be more productive than what we are giving it credit for? Because I just can't come up with another reason why we're not getting more kitchen sink earnings reports thrown at us. Is it the nature of the CEOs just to wait as long as they can? I know some of these S&P 500 companies haven't gotten beat up that bad yet because you have your old men that are still holding on. So maybe there's just one more bonus they're trying to squeeze out, or maybe things are really better than we think. We'll keep an eye on it. I do know that there's an awful lot of small caps out there that are pretty interesting. So I went through some of the big banks. And you see Morgan Stanley, BMO, Goldman Sachs, Citi all closed their hawkish Fed trades. Well, immediately the narrative becomes, well, they're bullish. No, they're just saying what I'm saying. So they're not sure. And if you're not sure, don't make a bet. All right. It's like flipping a coin. Do you really want to bet on flipping a coin? Especially if there's a VIG? No, you don't want to do that. JP Morgan and Bank of America still remain biased to the short side. Fed people are still really looking for higher interest rates, and they're being very hawkish. People that you wouldn't expect to be hawkish, like Cash Carey and Neil Kashkari is the most hawkish I've ever heard of in 15, 16, 17 years I've been following the guy. Right? Those of you in California know who he is. He ran for governor as a Republican by you. And now he's a Fed president in Minneapolis. So this is what we have to keep an eye on. At what point the U.S. Treasury signal a change in direction from choppy and down to probably choppy and up, right? Don't know. But I think there's still possibility for some bear market rallies. I think what I would expect the most is that we do get another rally, but I think we're in for a downturn for right now. Right as the puts go up, things will go down. And as the puts peak, they'll turn back. So I think the next couple of weeks look rough. Do we get a rally after that from the elections, from the Fed? Maybe for a couple of weeks. Things come back down, then a reload. So just watching the reload on the long and short side, your hedge fund style and put and call buyers, I think probably rough for a couple of weeks, and then a rally, then rough again. We'll see. We'll see if it plays out that way the rest of the year. But these really are moving fast. Look how tight these are. Really tight, the movements. Kind of like 2018 when things got super volatile. Right, that you see that they spread out a little bit more in between. I said that this year would be a lot like 2018. So far, it's followed script. We'll see how the rest of the fourth quarter looks. But stay with your energy, stay with your cash, buy your small caps and mid caps. And tell you what, EMQQ just doesn't get too much sexier. That's just as cheap as it can get. Yeah. So I bought my first tranche at 30. If it hit 24 today, then I owe more. I haven't even looked to see if I had a signal. Let me take a look. It's the high of the day. Days range 23.89. Yeah, I got more. I bought more EMQQ today. I just had it at 30 and 24 were my two prices. And you see how far apart that is. That's 20% apart. I think that if you wanted to make a trade right now and you're looking to generate some income, sell cash secured puts on EMQQ. There's almost no market for them, so I don't even know if that'll work. All right, so we need to find another emerging markets fund if we want to sell any options. So I'll have to find a better optionable emerging markets fund that's not a broad index. That's tough, right? Everybody wants to buy Vanguard's emerging markets, and it's just a crap fund. So we have to find something that's performing better. I suspect it's over here at Wisdom Tree. But let me find one more because we do need one more if we're going to sell some cash secured puts on the emerging markets, which those premiums we were kind of silly not to. All right, let me put together a report for you. Going to put out all my limit price orders, top dozen or so growth stocks, top dozen or so dividend stocks, companies that are close to where I want them. There's probably another leg down in this market. But again, who knows with the Fed? But international just looks really rough. And I think there are geopolitical reasons why that dollar is going to be kept up there just a little while longer, at least through the winter. People can live with 100-degree heat, put a fan on, but they can't, you don't want people freezing to death over the winter. So in the United States, our natural gas inventories are a little higher than we expected. And the price of natural gas came down a bit. I think that means you're probably going to see even more natural gas exported over to Europe, and that should bridge the gap. So I'm thinking we might not get that spike in oil and gas that everybody hopes for if you're, on the long side. But I do think that it's going to be a long time, 2 to 3 years minimum, and probably 4 or 5 years before we really have low energy prices again. I think 2026, 2027 is when we start talking about deflation again. And it's when energy prices really fall through the floor again. Between now and then, some of those energy stocks that we got picked out you just can see free cash flow, just tons and tons of free cash flow. It's really, really kind of amazing what the companies that are going to be involved in carbon capture are going to make. And I want you to think this through and do some reading. Let your Google clicker do the walk-in. Carbon capture with the tax breaks is a big deal. And it was made a big deal without any fuss, even from people who want to pretend that climate change isn't happening, because the governments of the world, over 100 of them, are afraid of climate change. The migration, the damage to coastlines, destruction of arable land. There is legitimate fear in governments because of what they know. Some of them try to tell us, and other ones run against it because, hey, that's how they keep power and make money. But carbon capture is going to grow, and it's going to grow fast. And if you've been reading any of the articles on jet fuel, you can see that Metis and a couple other companies are probably going to do really well. And ultimately, airplanes are going to fly on hydrogen. I just don't know how long that's going to take. 2040s maybe. So between now and then, jet fuel is a pretty interesting thing to sell and make money on, especially with biofuels also getting tax breaks. All right, everybody have a great weekend. And I'm going to a Badger game for the first time, and I don't remember how long, over 10 years, I think 15. So I will not be around on Saturday. I will get as much done today, tomorrow, and Sunday as possible. But I will get my limit orders out on a lot of things. All right, take care.